Welcome back to my YouTube channel, Mrs. Smith 88. So today I'm gonna do a Finance Friday video for you guys. If you guys watched my video where I did my house tour on my $170,000 house that I recently purchased, you know that I obviously financed a house. So I did mention in that video I would go more into detail about my loan and what my rate is, what my payment is, do the full Monty with you guys. So today's that day. I have my amortization schedule up in front of me. If you guys are not familiar with what an amortization schedule is basically it is a spreadsheet. You can use it in conjunction with loans. You can use it with a car loan. You can use it with a home loan. You can use it with a personal loan. And it will go through, you put in various details, which I'm going to explain in a little bit, and it'll show you what your payment is over time, and you can go in and make various adjustments like, hey, this month I want to make an extra payment. How's that going to affect my loan? I am totally obsessed with amortization schedules. I may be mispronouncing that. Little back history on me, believe it or not, I did go to college. I did study accounting, so numbers are my thing. Love math, love numbers. So this is just kind of second nature stuff for me here. So let's go ahead and get started. So I told you guys the house was $170,000. It was originally listed for $189,000. The seller dropped it down to $170,000 because if I'm being transparent with you, the seller did owe back taxes and was looking to get out of that situation. So I was very fortunate to be able to get that house for $170,000. And if you guys saw the video, you guys saw that it did need work. So the house was $170,000. I had spent the last 16 months saving over $50,000. That will be another video of, if you guys want, of how I saved up over $50,000 in 16 months, so what I did to get there and so forth. So house was $170,000. I was very firm that I did not want to pay PMI on whatever house I bought. I feel like if you are paying PMI, you are throwing away free money. And I understand, yes, some people are in predicaments where they need to pay that because they want to be a homeowner, because there's just a lot of scenarios out there. Honestly, if you can afford being a homeowner over a renter, it is definitely more beneficial, I feel, because oftentimes you can get a mortgage where your payment is going to be less than your rent. Yes, you are going to have other responsibilities. Like if something breaks in your house, you're going to be responsible for that. You're going to have property taxes and that kind of stuff. But personally, I think the pros of home ownership outweigh the pros of it being a renter. So this is the second house that I've purchased. My first one I cash paid for. That might be another Finance Friday of how I cash paid for my first home. That might be another video of whether we're going to rent or sell and that kind of stuff. As of right now, I have not sold that house. I feel like I'm rambling a little bit. I do apologize, and I'm not doing that on purpose. I'm doing it because I want you to know the whole situation here. So whole situation here is I owned my first home, bought it out with cash and that kind of stuff. So I have not sold it yet. That is not how I got my down payment for the new house. I saved my down payment for the new house. Didn't want to have to pay PMI. Was a stickler about putting 20% down. I thought every financial institution required you to put 20% down to avoid PMI. We financed through Third Federal Loan and Finance. They only require 15% down to avoid PMI. I did not know that, and I chose to still put the 20% down, even though I did not have to. I figured since I had saved it, might as well put it down. Not only that, it obviously put me in a lower payment arrangement. So I put the 20% down to avoid PMI, which ended up taking my total of what I owed on the house down to $136,000. Hopefully you guys can see my cursor here. Right here it says loan amount. This is the amount that you have borrowed, not the sale price of the home. If you enter the current balance of your mortgage, make sure you adjust the term length to be the amount or years that you have left on your mortgage. So I have financed $136,000 with Third Federal. We were very fortunate that during this pandemic, interest rates did drop, and we were originally approved with a 2.89% annual interest rate. Third Federal did have a promotion where if the rate did drop, you could lock in a lower rate one time absolutely free. My bank lady took total care of me. I didn't even have to call her up. She ended up calling me. She's like, hey, interest rates dropped. I locked you in at a lower rate. So our locked in rate for our home loan was 2.79%. Originally, when I was looking into financing this house, and I'll say my first home, financing my first home, because this is the first home I have financed, I was tossed between going with a 15-year home loan and going with a 30-year home loan. And what swayed me with the 15 versus the 30 is that if you are in a 30-year loan, most of the time you can overpay your mortgage and pay towards the principal without obligation and without being penalized. So I made sure that it was a penalty-free loan if I was to pay the house off early. Whereas if I went into a 15-year home loan, I would be obligated to always pay that amount. There are periods with my job where I do get laid off. I faced 3 layoffs last year. So yeah, 3 layoffs, and I still saved over $50,000 last year. So I didn't want to be stuck with that higher mortgage, even though it would be a shorter term. I'd rather make additional payments towards my principal to pay my loan off earlier. So my first payment date is May 1st of 2021. So I have not even had my first payment, and I was honestly a little bit mind blown by this, because honestly I figured I'm going to sign the papers on my house, my mortgage is going to be due the following month. And no, they do give you a little bit of time in between, and honestly I'm kind of grateful for that. I wouldn't say that we needed to have that extra time, but that puts me in a position where on month number 1, I will be able to make a rather large principal payment. So compound period here on the amortization schedule is set to monthly. Payment frequency is monthly. So my base mortgage rate on $136,000 is $558.09. My financial institution does require that property taxes be included in with your mortgage for the duration of your loan. So in addition to the $136,000, I do have $2,784.46 in yearly property taxes. Now, some of you might think, oh, that's rather affordable. There's other people who are like, wow, that's high. Because believe it or not, we were actually looking at houses in other states. We were considering moving to Horry County, South Carolina, which is where Myrtle Beach is. We definitely plan on actually buying a retirement home down the road down there. Their property taxes are astronomically low. But my property taxes here in Northeast Ohio are $2,784.46. My property size is the same size lot-wise as my current house that is paid off, but my taxes are higher because this is a little bit more upscale, a little bit more bougie of a community. So I'm okay with those taxes. So with taxes factored in, my mortgage is $790.13. So I feel that is really, really affordable. I did not want to live beyond my means. My husband and I, we make a fair amount of money. I hate to say it, I work 2 jobs, and it's not because I have to, it's because I want to. I get bored easily and that kind of stuff, so I work 2 jobs. He has a fair paying job as well and that kind of stuff. We could have probably honestly afforded a house that was probably $400,000 or more. But did I want that? No, I didn't want to be strapped to a mortgage like that. I sat back and I thought to myself, my husband is older. He's going to be 57 here soon. If he was to pass away, I want to be able to swing my mortgage on my own. So that's why I decided to go and not live beyond my means and that kind of stuff. I feel like we got a decent house for what we paid and that kind of stuff. And like I said, I want to be able to have that retirement house down the road and that kind of stuff. And I want that one to be the bigger and the bougier house and that kind of stuff. So yes, I did go below what we could afford, and I have no regrets on that because, like I said, why live beyond your means? Or why even live at your means if you can find something that is sufficient enough for you and your family that is more affordable? So over here, it does give you a balance at a specified year, and I will have a link to the amortization schedule that I use. So 5 years in, if I make just my minimum payment of $790.13, I will be down to owing $120,444.91. So here's the breakdown. 30-year loan, 360 payments, total payments, $200,914.47. If I make just the minimum payments without paying towards the principal, I will be paying $64,914.47 in interest. Now, I won't lie. Part of the reason I did not want to live beyond my means is because I want to pay this house off as fast as I can. Literally 10 years tops is my goal. So I want to pay this house off in a third of the duration of the loan. Honestly, I want to push to go even sooner than that. If I could transfer over my savings habits that I had for the last 16 months and apply it towards my loan, I would obviously have my house paid off in 4 years. 4 years. That would save a significant amount of interest. So I did go with a fixed rate loan. They do have really good rates on adjustable rate mortgages, but that intimidated me. Personally, I like consistency in life. I do not like variables. And I mean, yes, it can be beneficial to go with an adjustable rate mortgage, especially with the way that interest rates dropped this past year. To my knowledge, now forgive me, I have not researched this. Adjustable rate mortgages, what they do is they end up taking interest rates on a month-by-month basis. They go ahead, they add those up, they divide it by 12, and they get an average, and you pay that average interest rate price. Now, year to year, that's going to change. Like, as you guys know, if you've been following the interest rates, they are starting to climb. They are up above 3%, so I'm definitely glad that I got my approval when I did. My husband was dragging his feet on it and that kind of stuff, and I put my foot down because we initially missed a stunning house. It was $200,000, a little bit more than what I really wanted to pay. I set my budget to $185,000, but this house had all the bells and whistles. I originally set that I did not want a mortgage over $1,000. We would have been able to pull that house off as well for under $1,000 a month and be able to live completely comfortably. So that was my breaking point. That was, hey, we need to quit dragging our feet. We need to get our pre-approval. We need to get the ball rolling on this. And that is why we ended up financing when we did, and we got an amazing rate, and I'm really glad because those rates are starting to climb. So I'm going to scroll down to show you guys a little bit more of this amortization schedule. I do apologize that this is a long video. So this gives you a breakdown on a month-by-month basis of how much of your money is going towards your interest, how much of your money is going towards your principal. So as you guys see up here, the balance is $136,000. Month 1, May 1st of 2021. Obviously, they're expecting that $790.13 payment. Of that $790.13, $316.20 is going to go towards interest. $558.09 is that base payment before taxes. So this is not what is going to go towards the principal. Over here, of the $790, $241.89 is going to go towards the principal on that first payment, dropping the balance down to $135,758.11. They are going to put $79.05 in an escrow account to go towards the taxes for the year. So that's how it goes with month 1. What I want to show you with this amortization schedule is that you can factor in additional payments. So if I was to just double my payment, you would think, oh, double, that's going to cut your term down to 15 years. No, it would actually cut my term down to 10 years. 10 years owed because of how much I would save on interest. Like I said at the start of this video, I'm in a position where my first payment isn't due until May. I was honestly expecting it to be due April. I was also planning on doubling that payment. That's why I wanted a mortgage under $1,000, because I wanted to be able to easily double my payment. So I have some wiggle room to not only throw down a double payment, but potentially a quadruple payment. And I'm thinking even bigger than quadruple. So we're just going to play around here. I'm going to go ahead and throw in a number. So let's say that I pay the base mortgage rate of the $790.13, and then I'm able to make an extra payment of $2,500. So let's go ahead and type that in. We're going to hit enter, and we're going to see how this ends up adjusting the mortgage. So we're going to go ahead and slide up here. So obviously, if I paid an extra $2,500, that would be $2,741.89 going towards the principal the first month. That would drop the balance down to $133,258.11. So instead of being down to 359 payments that first month, we would then be down to 350 payments. That extra $2,500 is going to shave off 9 additional payments. Not only that, it is going to save me in interest. So if I pay an extra $2,500 the first month, I'm going to save $3,100 $1,392. Oh, 93. $3,193.26. That's more than the extra payment. Like, that's insane. That's mind-blowing. So that's just $2,500. I am thinking that I have room to definitely do $4,000. So let's go ahead and factor that in. Now, ultimately, I will do an update video month to month and show you guys where I am at with my mortgage. So we're going to go ahead and change that extra payment to $4,000. So that would drop my balance down to $131,758.11. That'll be $4,241.89 paid towards the principal. That would take me down to 344 payments left on my mortgage instead of 359. So $4,000 would shave off an additional 15 months. 15 months on my mortgage. That's more than a year right off the top of my mortgage by being able to put an extra $4,000 down. That $4,000 would save me $5,045.58 in interest. So that is why I keep an amortization schedule, because I like to have the ability to play with these factors and see how it affects my mortgage. So I went ahead, I cleared that out. That way when I do make my first payment, I will be able to come back to this and it will be accurately updated. Like I said, I will do a monthly video with you guys showing you guys how much extra I paid on my mortgage and what kind of effect it had on my loan. I hope you guys enjoyed this video. If you guys have any questions, feel free to leave them down below. Don't forget to comment, rate, and subscribe. Thank you for watching, and bye everyone.